We all want some level of safety and security. Firefighters, construction workers, EMT. They're all there when you need them to help manage life's chaos. In retirement, you want that same level of safety, but who is there for you to make sure your money will last? Brian isn't just there in case of emergency. He's there so you don't have an emergency with your money. A safer retirement doesn't mean a boring retirement, but a prepared one, full of the things that inspire you. This is Safer Retirement Radio with Brian J. Decker.
Welcome to Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning. Also joining us today, Arrin Wray. You can find out more about Arrin, Brian, and the team just by going to the website, deckerretirementplanning.com, deckerretirementplanning.com. And I always tell you, you have the option to go to their website, deckerretirementplanning.com, to pull up any or all of the things that are available for you to download. You want to learn more about retirement? Well, there you go. You got Brian's book on retirement, The Decker Approach, the Checklist Challenge, Sample Income Plan. But you also have the 3 Principles of Retirement book, which is what Brian and Arrin are going to talk about today. All of that is available to you, deckerretirementplanning.com, under the heading of Safer Retirement Education. 12 different things you can download. Books, those 2, Brian's book and the 3 Principles of Retirement book. And then there's those useful guides as well. So 12 different things you can download, no cost to you. It's there for your information. deckerretirementplanning.com, under the heading of Safer Retirement Education. I'm Mark Elliott. If you have any questions about anything that Brian and Arrin talk about today, or you just have your own questions as it pertains to retirement, it's 833-707-3030. No cost to you, no obligation, no pressure. Arrin, Brian, and the team, they hope they can help you, but they don't know if they can help you. You don't know if you're going to be a good fit for them or they'll be a good fit for you. They're not right for everybody. But if you have questions, you want some clarity into your retirement picture, give the team a call. Find out more, 833-707-3030. All right, Brian, the 3 Principles of Retirement book, we talk about it being available all the time. You're actually going to break it down a little bit for us today, you and Arrin.
Yep, we're going to go into a lot of detail on this. So, Mark, we'll dive right in. So, Arrin, let's start with principle number 1. Always draw income from principal guaranteed accounts, or to be said on the negative side, never draw income from fluctuating accounts. Take us through that first principle.
Yeah, it's one of the biggest mindset shifts that I think we have to talk through with our clients when they're shifting from their working career into retirement, because you build up phenomenal habits of saving, adding to your 401k accounts, not touching those accounts for a long period of time. And the goal, for the most part, is just grow that account for the point in time that retirement actually rolls around. And then it's a difficult switch for people to say, hey, I've had the majority of my portfolio in stocks or these high risk or high growth type investments for the last 30, 40, 50 years. And now it's time to be able to take a different approach for the use of those funds, because previously you had your paycheck coming in, right? Every couple of weeks, you got a paycheck coming in that's providing for your living expenses. These accounts, whether they're 401ks, IRAs, savings accounts, whatever it is you have that retirement money sitting in, is not needed for living expenses right away. And so at the point in time that they do retire and they then are starting to take withdrawals from those accounts, the investment strategy also needs to change. And so the problem with continuing that same investment strategy is that if you have most or all of your retirement funds in some type of stock or equity-based investment, that has volatility attached to it, sometimes very, very big swings. I mean, we've seen in the last couple of years, 25% up, 25, 30% down, and that is not unusual. Those types of swings happen all the time in the market. And so if you continue to take that same type of approach while you are pulling money out of it to live off of, what you're doing is you're compromising your gains on the upside when the portfolio goes to the positive side, and you're accentuating your losses on the downside. So it's not a good thing on either end of that. And the best way to do that is to be able to, or to adjust that, is to draw from principal protected accounts. So these are the types of investments that don't have the ability for loss. So when the market takes a huge nosedive, as it typically does every 7 to 10 years, you're not going to take a huge reduction on your portfolio, which also means you're not going to have to cut back on your spending. And so that's really what I think a lot of people need to relate this to, is that not only is it helping protect you from portfolio losses, it also means that the amount of money you're going to spend per year or per month is not going to be jumping all over the place, depending upon what the market returns are. So that's a pretty important principle, and one that we always like to start with as kind of a foundational element for the rest of what we cover.
Yeah, you covered that perfectly. The tools that get you during your accumulation years to your retirement stage are not the tools that work when you're in your distribution phase, in your 20s, 30s, 40s, 50s, when the market cuts your 401k in half. No big deal, because you're getting your income from work, and every 2 weeks you're still contributing to your 401k that's been cut in half. And in the 3 to 4 years, maybe 5 years that it takes for the markets to recover, because you've dollar cost averaged into it, you actually benefit. But as to your point that you've made, Arrin, when you're 65 plus and retired, now your income's coming from your portfolio that's down 20, 30, 40%, and you're drawing income from it. That is a life changer. I'll never forget, I started in 1987, just in time to build my book for Black Monday, October 19th, 1987. Markets were down 22% in a day, 30% peak to trough. And my manager came through the office the next day and said, Brian, I need you to call all your retired clients and tell them it's probably best to put off drawing from your portfolio until it recovers. And so dutifully, I made those calls. And Arrin, they were incredulous. They said, oh, really, Brian? Put off money drawing from my portfolio to let it recover? Why don't you call all the people that I pay my bills from and tell them that Brian Decker said, I need to let my portfolio recover. I knew in the first 18 months being a stockbroker that the pie chart hurts people in retirement. Said another way, accumulation strategies will hurt you in retirement. And Arrin, you covered this. I just want to say the same thing you said differently. Mathematically, when you draw income from fluctuating accounts, you compromise gains, like you said, and accentuate losses when markets go down, and it works until it doesn't. And there will be a time when it doesn't, and those people will have to go to plan B. They'll have to go back to work, move in with the kids, sell their home, do something, but they're going to have a life-changing event in retirement unless they follow this first principle, which is to make sure that you're drawing income from laddered principal guaranteed accounts. So, Arrin, when we talk about laddered principal guaranteed accounts, surely you give up returns, do you? I mean, so he asked the question, do you give up returns by going into laddered principal guaranteed accounts? So tell us generally what the returns are, and then go into some of the different types of investments that we use for the different principal guaranteed accounts, so that radio listeners can kind of get a picture in their minds of how we do it.
Sure. So this is something that is also a very foundational element of what we do here, where laddering out these principal guaranteed accounts from a return standpoint is something that will protect you in the short term, because like I mentioned earlier, these don't have the ability for loss, and over the long term provide a much smoother approach to not only the growth of your portfolio, but also for the distributions from your portfolio. Like I said, most of our clients aren't interested in having whatever the market return is in general be the dictating factor about how much money they can pull from their portfolio year over year. Most people want some sort of consistency, stability, some level of solid expectation for what they can plan on from a spending standpoint. We want to be able to provide that math-based, numbers-based approach that we want to give to our clients so heavily. And so as far as actually structuring that out, there's a few different ways that we do this, but the general approach is making sure that you can pull your income, that monthly income, yearly income, from these protected accounts for about the first 20 years. And then we continue that down the road. So meaning we set up a plan where different investments are put into place. Certain of them are these principal guaranteed accounts, and their job is to provide protection, income, and a moderate rate of growth for the time period that they're being used as income. So typically what we'll do is we'll ladder these out. There's usually 4 to 6 accounts in separate time periods where it's money that's going to be used right away in 3 years, 5 years, 7 years, 15 years, whatever time period down the road. And to your question about returns, it's going to depend on the product a little bit and the time period a little bit, but a lot of the shorter dated fixed rate investments that we're looking at now are going to be in the 5 to 6% range. And then when we get into longer dated time periods, 10 years, 15 years, 20 years, typically those are variable returns, but a lot of those right now are averaging in the 6 to 8% range. So especially right now where the Fed rates are higher, I'm sure people have seen this at the bank. You go 2 years ago, CD rates were 0.2%, 0.3%, not even worth locking your money up for. And now you can go there and get a 1 or 2 year CD and it's most of the time 5.5%. And so along with Fed rates increasing, a lot of these variable rate products have also improved their ability for returns. And so even while having the protection, hitting 6 to 8% on average is a pretty good way to be able to draw funds from your portfolio. So those are critical to the way that we've set our plans up because like you mentioned earlier, Brian, having those swings in the market can destroy your portfolio if you aren't invested properly. The people have seen a little bit of a dip in 2022, very small one in 2018, but we haven't had a major market crash for a while. And I think people kind of get a short-term recency bias where they're like, it's been good for the last 10 years, 10, 15 years, probably going to continue that way. And they kind of get this short-term view that even though they may live another 20, 30, 40 years in retirement, they don't consider their portfolios at risk. And so that's one of the things that we try to highlight is just making sure that you realize that, yes, there have been some good years. Most of the time the market goes up, but it doesn't always go up. And when it doesn't, that's really when you need those protection vehicles in place. So just some important points there for people to think about as they're transitioning into that protected necessity environment.
So Arrin, let's talk in the next segment about what accumulation planning puts forth as safe money and go into details. We're going to talk about interest rate risk. We'll talk about the interest rate cycles for the last, going back to Abraham Lincoln. We have data back to Abraham Lincoln. Abraham Lincoln got 5% on his 10-year CD. Do you remember that?
Crazy.
Yeah. So interest rate cycles seem to go in 40-year segments. In 1940 to 1980, 40 years of the 10-year treasury go from 2% to almost 15%. 1980 to 2020, 40 years going from almost 15 down to 0.47 in August of 2020. We're going to fill in the blanks on where their interest rates go from here and talk about what's safe and what's not safe in retirement.
So again, Brian and Arrin are talking about the 3 Principles of Retirement book that is available to you on their website, deckerretirementplanning.com, under the heading of Safer Retirement Education. It's one of 12 different things you can download, including Brian's book on retirement, The Decker Approach. But they're talking about the 3 Principles of Retirement book that is available to you at no cost, deckerretirementplanning.com, under the heading of Safer Retirement Education. If you'd like to talk to him, boy, I don't think I have that safe, protected income for my retirement. I'm not sure how to do that. It's an opportunity for you to find out more by talking with Brian, Arrin, and the team at Decker Retirement. 833-707-3030. No cost, no obligation, no pressure. Get some clarity into your situation. And having guaranteed income would be pretty nice. If you don't have a pension, how do you create guaranteed income? 833-707-3030 to chat with Brian, Arrin, and the team at Decker Retirement. 833-707-3030. Back with more about the 3 Principles of Retirement book with Brian and Arrin right here on Safer Retirement Radio.
Have you ever done something and then thought, well, that was a giant waste of money? You might have that same thought in retirement if you don't plan for taxes. Call the team at Decker Retirement Planning to make sure you aren't giving more to Uncle Sam than you have to. 833-707-3030. That's 833-707-3030.
Who likes uncertainty? Wall Street certainly doesn't. With near record inflation and partisan politics, there's a lot of uncertainty right now. What will America's future look like? What will your future look like? Will your taxes go up? Will your savings go down? For more than 3 decades, Brian Decker has seen uncertainty come and go. No matter what the future holds, Brian and the team at Decker Retirement can help you create a plan designed to preserve your finances in uncertain times. And it's not a matter of if those uncertain times will show up, but when. Call 833-707-3030 now to meet with Brian Decker and the Decker Retirement Team. If uncertainty is causing you to feel insecure, Brian Decker can help. Call 833-707-3030 and schedule your visit today. 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor. Investing involves risk, including the potential loss of principal.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning. Again, you can always go to the website to learn more, DeckerRetirementPlanning.com. But you can always call them if you have questions. Boy, I think I've got enough. I hope I've got enough. Wonder if our money's going to last as long as we need it to last. Are we going to be okay if we retire? 833-707-3030. 833-707-3030. No cost for you for this chat. 833-707-3030. I'm Mark Elliott. Brian and Arrin today discussing one of the free books on the website, DeckerRetirementPlanning.com, under the heading of Safer Retirement Education, the 3 Principles of Retirement book. And that's what they're talking about. Brian, where are you going in this segment?
We're going to talk about the accumulation strategies, quote unquote, safe money. Arrin, what is it and how does it work? And what are the risks of the safe money of the pie chart?
Yeah, so safe money, I feel like is kind of a misnomer, especially for those accumulation portions of your portfolio. So a lot of times what happens is people say, okay, I have 20, 30, 40 years till I retire. And the general premise or the general rhetoric in the financial industry, people say, hey, as you get older or closer to your retire date, you should put an increasingly larger percentage of your overall portfolio into bonds or bond funds. It's kind of where that 70-30, 60-40 portfolio approach comes from. Now, people think that the bond portion, typically that 30, 40, 50% portion, is the safe money in the portfolio. And that is a little bit misunderstood because bonds and bond funds have what's called inflation and interest rate risk. So a lot of times, I guess the most recent example of this is in 2020, 2021, when interest rates bottomed out, the Fed started dramatically raising them. A lot of people were really confused, especially in 2022, that the stock or equity-based portion of their portfolio was down 20 to 30%, and the bond-based portion was also down about 20 to 30%. Going, hey, wait a minute, I thought this was supposed to be the safe portion. I thought this was supposed to dampen volatility and provide me a little bit of protection. What happened? And what a lot of people miss is the inverse relationship between bonds and bond funds and the level of interest rates, where as the Fed dramatically raised them to the 5.25%, 5.5% that we're at right now, those bond portions of the portfolio took a huge hit. And so where it's supposed to be safe money, supposed to protect the assets, that portion of the portfolio didn't do its job, especially if you're in retirement. If you lost expecting to have a protected portfolio, if you lost another 20 or 30%, that goes back to our discussion just a couple minutes ago, where you don't have the ability to pull the same level of income out of those accounts as you used to. And that either means you have to cut back, take on more risk than you'd like to try to make it back, some other not so fun decisions when the portfolio doesn't work like you expected it to. And so when we use our protected and principal guaranteed accounts, they don't have that same level of interest rate risk. And so it does actually provide the protection that you were expecting. So on the bonds and bond funds, it's one of those things that people confuse a lot. So Brian, I'll kick it back over to you. I know you get all riled up about this, and rightfully so, because of the dangers it has caused and the specific situations that you've seen in the past.
Yeah, I just want to emphasize that the accounts that we have don't have any interest rate risk if that definition is losing money when interest rates go up. So we use securities, we use investments that have zero interest rate risk that don't lose money when interest rates go up. So you're right. I'm passionate, Arrin, about the stupidity of the industry, the bankers and brokers that were still recommending bond funds when the 10-year treasury was at 0.47%, less than 0.5% of interest rate gain. That's like investing in the Dow Jones when the total upside possible is 35,000 and you're at 34,800. Nobody does that. The gain is so small and the downside is huge. And that's what we were facing. But by robotic just example, because we've always done it this way, bankers and brokers were recommending bond funds with huge downside risk, interest rate risk. And so, for example, in the last 3 years, bond funds on average have lost about 35%. And the bankers and brokers are still recommending them to be used as their quote unquote safe money. Well, color me skeptical, because from 1940 to 1980, 40 years of interest rate gain, interest rate cycle headed up. Then from 1980 to 2020, 40 years of interest rates decline. Now, a lot of people think that the Fed is going to reduce rates. It was 6 times in 2024, but now when Powell came out and said that's not going to happen, so the market is, the stock market thinks that it's now not 6, but 4. Well, if the Fed pulls off a soft landing, Arrin, why would the Fed cut rates? And by the way, the hint is there's 34 trillion reasons why the Fed wants lower rates. It's the debt. So they want lower rates. They want to go that direction. And we used to call this 3 years ago, it would hurt seniors, people that were retired, because they were getting almost nothing on their CDs. Well, now they're getting something. And so there's kind of a tug of war going on right now with interest rates. On the one hand, the Fed wants to bring rates down because to lower the interest rate on the debt. They have a vested interest in getting that rate down. And we've got something, I don't know, I can't remember what the number was, something like 9 trillion of that 34 trillion that's coming due in the next 6 months or so. And the Fed would like to have a lower rate on that. So that's one pull for rates to go down. However, some very smart people that we read in research are saying you can't move 34 trillion in volume. That supply is so huge that to equal supply and demand, you have to raise the rate to move that kind of volume. So that's the other push-pull, the tug-of-war that's going on that says that rates can't go down. You can't move that volume at a lower rate. So we'll see what happens. We don't know what's going to happen, but we certainly are against putting retirement money in jeopardy where you're using bond funds, where if interest rates go down from here, you get an okay rate. Say the 10-year treasury right now is at 4.1%. Let's say you get 5%, but if interest rates go down, you pick up another fraction of a percent, 4.5%, maybe 5%, 5.5%, something like that. But if rates go against you, if rates go up from here, like some people are saying they will, you don't get 5%. You get 5 minus the loss of the interest rate risk. So rather than do that, we're fiduciaries to our clients. We're not going to put them through that. We are going to use laddered principal guaranteed accounts. And Arrin, you gave some good rates. We're getting 5% on the cash accounts we use. We're getting on 3 and 5 year, we're getting 5.5, 6. And then 7 and 10 year accounts, we're getting, like you said, 6 to 8. And those are taxable, but we have tax minimization strategies where on most all those buckets, we want to tax defer those gains so that we don't get taxed on the gain until we pull that income out. But then there's also a tax-free principal guaranteed account. Arrin, talk generally about how that works, because that's one of the buckets that is available for people that qualify.
Yeah. So on a lot of the accounts, depending upon the tax type, there are different advantages. And a lot of the accounts that we use do have a tax deferral on them. And so you get to compound that money until the point in time that you actually take a distribution out just to spend the money or to shift it elsewhere. But this account, it's in certain shapes and forms works very similarly to a Roth in the sense that once you have the amount of money invested, the account grows tax-free. You're able to take income out of it tax-free, and the death benefit when you pass away is also tax-free to your beneficiaries. And so this is a really, really tax-advantaged account for those people, especially that have high levels of what's called non-qualified money. Basically, after tax, the funds that you have sitting in your bank account, checking account, brokerage accounts, those types of accounts. And it's a great way, especially if you're in a high federal marginal tax bracket, to be able to bring that down both now and later in your retirement years. I think we're all in agreement that it's very likely tax rates are going to go up in the future. And so if you're already in a 22, 24, 32% tax bracket, it's possible that you're in a 30, 35% tax bracket down the road, and being able to put more tax advantaged money to work and have that lower even while you're still able to take income from it can be really, really helpful later. So that's one of the accounts that's really helpful if it's a good fit for the clients that we put it into place for.
So Arrin, let's go. We spent almost half the show talking about the importance of laddered principal guaranteed accounts. Let's hit principle number 2 after the break and talk about diversifying and balancing investments by purpose for client portfolios.
Perfect. So that all ahead right here on Safer Retirement Radio with Brian and Arrin of Decker Retirement. Again, if you would like this book, the 3 Principles of Retirement book that Brian and Arrin are talking about today, it is yours at no cost. All you have to do is go to the website, deckerretirementplanning.com, under the heading of Safer Retirement Education. There's 12 different things you could download, but the 3 Principles of Retirement book is right there as well. You want it? Download it. You got it. Also, if you have questions, because think about income. Where's your income going to come from in retirement? Do you have enough? Will it last as long as you need it to? Are you going to be okay? That's really what you want to know. Can I retire? And will I or will we be okay? That's what we want to know. That's what Brian, Arrin, and the team at Decker Retirement are all about. Creating your safer retirement really process, income, investment, taxes, healthcare, legacy planning, Social Security, Medicare, all those decisions you have to make. And it really starts with income, which is where Brian and Arrin started. But there's more. And that 3 Principles Retirement book, that's where they're going next. 833-707-3030. 833-707-3030. No cost to you. One of the great opportunities for you to get some clarity into your retirement picture. 833-707-3030. Brian and Arrin back with more Safer Retirement Radio right after this.
Do you need help ensuring any remaining assets that you've worked so hard to create are distributed to your beneficiaries in the most tax-efficient manner? If you would like to talk or meet with Brian about your legacy planning, call 833-707-3030. Again, that's 833-707-3030.
Glad you're with us today for Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning. Again, we're talking about the 3 Principles of Retirement book that is on the website. If you want it, you can have it. Just go to deckerretirementplanning.com under the heading of Safer Retirement Education. And there are 3 Principles of Retirement. That's what this book is about. That's what Arrin and Brian are discussing today. Of course, you have questions. You want to learn more about your specific situation, 833-707-3030, 833-707-3030. So the first principle, Brian, draw income from principal protected accounts. And you spent half the show on principle number 1, but now you got to get to principle 2 and 3. What's principle number 2?
We're going to have to squeeze this in and talk quickly, Arrin, to cover this. So this is where we recommend that clients diversify and diversify their investments based on purpose. So Arrin, tell us what that means.
Yeah, so the point here is you have spent a lifetime as a client saving up your assets, working, setting aside those assets in whatever shape or form they may be, and now it's time to actually use them. And a lot of times people want to carry that same mentality of their investment style, investment vehicles into retirement when the purpose for the funds now changes. And so really what we focus on here is it's not as though you have to give up all growth. We still want that to be a portion of your portfolio, but there's other things that you need to use the money for, which also means that there's going to be different investment strategies, different investment vehicles that are better suited to those responsibilities. So with every account that we open, every time we invest money, we do so with a specific purpose in mind of what's the purpose for this account, when is it going to be used, what's the focus as far as growth or income or protection. And so we typically talk about 3 different sides of a triangle. That's going to be principal protection, liquidity, and growth. And so of those, there's going to be specific investment vehicles and strategies that lend themselves better to those aspects than others. And so you typically are able to pick 2 of the 3, but not all 3 with any given investment. If somebody's promising you protection, liquidity, and growth, big red flag, probably a scam. So when we talk about those things, for example, the easiest one people come to or have come to mind is like a savings or a money market account. Those are principal protected. You can't lose money in those accounts. And they are also highly liquid. You can pull money from them whenever you want. But they are not high growth accounts. You're not going to get a 10 or 15% return if your account or if your funds are sitting in a money market account. And so there's other investments that are more focused on growth. And so the purpose here is to make sure that every bucket of money that we help you put into place has those things laid out as far as why we're doing that. It's not just a willy-nilly, let's throw something at the wall and let's hope it works. Again, we're very math-based, and we want to show you exactly why we're investing the money the way that it is. Every client's goal is going to be a little bit different. We have people that very, very much want all of the protection that they can have. They don't want to have as much risk anymore. They want to really dial that back. They're not comfortable with volatility, and that's totally fine. We can accommodate that. We can put together a plan that meets those goals and helps address those concerns. On the opposite side, we have people that have done a very, very good job saving, and they don't really need all the money that they've put together. So they're much more focused on growth or liquidity for other charitable giving or helping their kids or giving a big inheritance or things of that nature, where maybe the protection aspect isn't as much of a focus for them. And again, we want to make sure that each bucket of money is invested properly to hit those goals for you. And so that's why we spend so much time going through an evaluation with our clients, make sure that we know exactly what their goals are, what their concerns are, what they're hoping for, what they need, what they're willing to tolerate as far as risk and volatility. There's a lot of work that goes into deciding where this money ends up. But at the end of the day, we want to make sure that those principles are addressed as far as each of the principal protected accounts, liquid accounts, or growth focused accounts, and that meets the needs that you're looking for.
So in 30 seconds, stocks and growth accounts are liquid and growth. That's 2 of the 3. They're not principal protected. And cash is an account that's principal guaranteed and liquid. And when it comes to the higher earning principal guaranteed accounts, those are growth. Those are principal protected. But to the anger, Arrin, of a lot of people, they're not liquid. Are you telling me that there's no principal guaranteed growth account that's next day liquid?
This is always a fun conversation. People get to retirement and sometimes have a difficult time with the liquidity restrictions on certain investment vehicles, but they forget the fact that they've had 401k accounts, IRA accounts, Roth accounts that they haven't touched for the last 40 years, that were very much not liquid for a very long time. And so at the end of the day, there's going to be trade-offs for each of these. Like I said, it's 2 out of the 3 for the most part. And again, if somebody's promising you all 3, probably need to look into that a little bit heavier.
Well, let's talk about one example that has promised all 3. And that is an account that guarantees you 7% for 10 years, is principal guaranteed, and pays you 4% for life. That hits all 3.
Yeah. So, well, depends on how you look at the math. So let's run through an example here. Let's say you take that, you have that 7% guaranteed return for 10 years. Let's say, easy math, you put $100,000 into this. So $100,000 grows to just shy of 200. So you've basically doubled your money after a 10-year time period. You then start that 4% per year payout. Now, how long does it take if you're going to get 4% per year to get your original $100,000 back? And the answer on that is 22 years. From the time you start it, grows at 7% per year for 10 years. You then start your 4% per year payout. It's a 22-year break-even period just to get your original 100 grand back.
With no growth.
Yes, with no growth. And this is one of the things that really I don't know, you're on the same boat, Brian. We're on the same page here. I hate these ones because people don't really understand what it is. They get into these investment vehicles. They think they have a good thing coming. And then we actually walk through the math and the steps and they're like, oh my goodness, I never would have done that had I understood what this actually entailed or how long it took me to get my money back or some of the limitations. And so there are so many different types of investment vehicles out there, and we do a really good job staying on top of them. So if you're listening to this and you have somebody that's presenting something to you like this, you're like, hey, this sounds too good to be true. I don't know if I believe this. Just come talk to us. Say, hey, look, I'm being presented XYZ investment. What do you think of this? And we can give you the real honest look at that, show you what it means, show you situations where it may or may not be good, and really help you peel back the layers of what it is so that you know with certainty what it is you're actually getting yourself into so that you don't end up in a situation 10 or 15 years down the road where you're like, wow, that was not the right choice. I really wish I would have dug into that a little bit further before making a decision. So
Arrin, let's put this in perspective on a template for our radio listeners. There is a spot for cash, there is a spot for principal guaranteed, and there is a spot for growth. Those are the three different types of investments we just covered. Where is the appropriate spot for each in the retirement plan?
Yep. So we always want to make sure to have a emergency cash account. So this is typically anywhere from $25,000 to several $100,000, depending upon the size of the client and their specific needs. And then we also have, so that's going to be the cash portion, 100% liquid, principal protected. The second portion, those principal protected and growth accounts, those are going to be the portion that's focused on protecting money, providing income, and helping you have a decent rate of growth while protecting those funds. So that's going to be a good chunk of the overall funds as well. And then the last portion, the growth accounts, those are going to be focused on what we call our risk portfolio or our risk bucket. And these are, for the most part, going to be the growth and liquid investments, where these are going to be different stock and equity-based investments. And this is long-term money. These are not accounts that we're going to be taking withdrawals from in 1, 2, 5, 10 years. We want to make sure that you have the ability to ride out any market volatility so that you're not in the situation that we described earlier. Your portfolio takes a 30, 40% hit. You have to take money out of the account to live off of, pay your bills, pay those expenses. And now you've just exacerbated that downward problem. And so these are not accounts that we pull from on a regular basis for the actual living expenses that you need to take care of. This is money set aside, similar to when you were working and had your 401k growing, that we want to make sure that you have that growth so that you can have this money available to you later down the road in retirement to be used as part of the income producing.
So Arrin, I just want to talk about the three genius parts of the distribution plan that you just went through in placing cash, safe money, laddered safe money, and risk. So genius part number one is we can go through a period like 2022, S&P down 19, NAS down 33, bonds down 20, and our clients didn't lose a dime on the principal guaranteed accounts. In fact, they made money in buckets 1, 2, and 3. And in overall portfolio, we actually made money. So we're one of the few people in the country that made money in a very difficult year like 2022. Genius part of distribution planning number one is through most any environment, you're going to be okay. You're not going to be sent back to work or requiring to sell your home or move in with the kids. That's genius point number one. Point number two is that while we are drawing down for the next 15, 20 years from the laddered principal guaranteed accounts, we are growing the risk portion of your money to more than offset what you started with. So if you start with 1.5 million, in 20 years, we're going to take 75% of that, get a good return on that with the principal guaranteed laddered accounts, send it back to you, principal and interest, and then grow the 25% over 15 to 20 years to more than replace the starting balance of 1.5 million. That is genius point number two. Genius point number three is using compound interest to our advantage in the distribution plan. So bucket one, cash account, say we draw it to zero in 5 years. In 5 years, let's say we start with 1.4 million. And in 5 years, Arrin, I know these numbers by heart, we draw 230,000 in the first 5 years. We started with 1.4. And because we're drawing from the lowest, this is the key, the lowest earning account, it gives 5 years for the 3 higher earning accounts to grow and compound more than offsetting what we drew out of the account in the first 5 years. So it actually goes up. The total value goes up, even though we've drawn 230,000. Next 5 years, bucket 2 grows for 5 years, pays out for years 6 through 10. And now after 10 years in this example, we've drawn 550,000 out from 1.4 million. And the account is still going up because in 10 years of drawing from the 2 lowest earning accounts, it gives 10 years for the 2 higher earning accounts to grow and compound more than offsetting that.
So really the question is, do you know how to do all of that Brian and Arrin were just talking about, or would you like some guidance? If Brian and Arrin and the team could give you 1 or 2 ideas to make your retirement better, wouldn't that be worth the time to give them a call? 833-707-3030. Back with more with Brian and Arrin right here on Safer Retirement Radio.
Do you need help ensuring any remaining assets that you've worked so hard to create are distributed to your beneficiaries in the most tax-efficient manner? If you would like to talk or meet with Brian about your legacy planning, call 833-707-3030. Again, that's 833-707-3030.
Have you noticed the market's roller coaster ride lately? Even a single day's dip can significantly impact your retirement. If the idea of shielding your nest egg from market volatility resonates with you, it's time to talk to the experts at Decker Retirement Planning. Call us now at 833-707-3030. Our unique approach aims to dial down the risk, keeping about 25 to 30% of your assets at risk, instead of the conventional 60-40 pie chart. At Decker Retirement Planning, we don't use a pie chart. We strive to offer you a detailed retirement income plan. It's about seeing the bigger picture, aligning your investments to your long-term goals, and making informed decisions. Whether you're new to retirement planning or already have a plan, we can help. Call Decker Retirement today to learn about the 6 things we do well for our clients that all financial advisors should be doing. Call 833-707-3030 today. That's 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Glad you're with us today for Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning. Brian and Arrin talking about the 3 principles of retirement book. They've covered the first 2. The first principle, draw income from principal protected accounts. The second principle, diversify and balance investments by purpose, meaning you can't get all 3 of principal protection, liquidity, and growth. You can't get all 3 of those from one tool. So you have to diversify. You get 2 of 3 basically with the different tools, but you can't get all 3. And then the final of these principles for retirement, use a distribution plan, not a pie chart. And Brian and Arrin are going to talk about that. If you would like the book, though, all you have to do is go to the website, DeckerRetirementPlanning.com. Under the heading of Safer Retirement Education, there's 12 different things you can download, including Brian's book on retirement, The Decker Approach, Checklist Challenge, Sample Income Plan, or 4 of those, including the 3 principles of retirement book. So we got one more principle to talk about, and then we'll wrap it all up to wrap up today's show. But if you would like to sit down and talk with the team, you got some questions, you don't really know how to do what they've been talking about, you're not really sure, do you have enough? Well, our money lasts as long as we need it to. Don't really know. 833-707-3030. 833-707-3030. Brian?
Okay, Arrin, this is going to be a challenge. We got 11, 12 minutes to go through probably the most foundational, important part of retirement planning we do, which is the distribution plan. So since we're a math-based firm and fiduciaries to our clients, you would expect nothing less than a spreadsheet. But Arrin, explain for the radio listeners the spreadsheet, how we use it for income planning, for tax planning, and for portfolio planning.
Yeah, this is actually one of my favorite things that we do. I'm an analytical person by nature, and so I really like being able to see the numbers, the visual, the projections, the forward look at how we can actually project out what your income is going to be. And so this is really where we start as far as the planning process from a foundational standpoint. And the entire purpose of that distribution plan is really to answer three main questions. Number one, can we retire? We have a lot of people that come to us that say, hey, I don't know, a couple years out from retirement. I don't really know if I'm going to be able to hit the goals that I have. I would really like to retire sooner if I possibly can. And they're kind of in this limbo stage where they've built up these good habits of working, and now they're getting closer to that retire date, and they don't really have a good strategy or a good knowledge of where to go from here. And so we get a lot of people that are like, look, I don't have a plan. I want to be able to figure this out. I want to have the peace of mind that comes from knowing I can have enough income for the remainder of my life. And so that first question is, can we retire? That's a big one that we talk about. The second one is, how much money can I spend? So we are definitely not the just wing it approach. We want to make sure that we can show you by the math, by the numbers, how much income you can conservatively project throughout the remainder of your retirement years. Nobody wants to get into retirement for 10, 15 years, realize there's been some financial miscalculations, and then have to go back to work, cut their spending, do some other not so fun things. So we take a very conservative approach in the way that we project this out. And we want to show you how much income you can have until the point in time that you pass away. So that's the second part. And then the third is, what do we actually do with the money? This is where the investment allocation, the tax planning, all of those other aspects comes in to make sure that we can optimize every piece of that. Because at the end of the day, yes, the point of this money is to help you sustain your life through retirement, but you want to make sure that you take as much advantage of those different vehicles and strategies as possible. And so really what we do here is go through a number of meetings to be able to iron out, okay, what do you want? How do we get there? And what are the specific details that we need to implement on that? So the income planning portion of this is, like I said, foundational. We want to make sure you have enough money to last you for the remainder of your life. And this is important for people that are already retired, for those that have yet to retire. And we see people on either side of this spectrum, in the sense that people come to us and realize that they have been way underspending relative to what they could be. We have people that just don't want to run out of money. They haven't really had a good plan in place in the past. And so they've been very conservative in their spending habits. And then we show them by the math, by the numbers, hey, you can actually spend a fair amount more than you are and still not have issues as far as running out of money towards the end of your life. They're ecstatic. They can go do all those fun things that they've wanted to do, travel, spend time with their grandkids, additional charitable donations. That's always a great conversation to have. The number one fear of retirees in the US is running out of money. So again, we want to provide you that peace of mind that you have enough to last you as long as you need. And on that opposite side, again, we help people all the time from, hey, a couple years out, can you tell me when I'd be able to hit these specific income goals that I have? This is the amount I want to spend per month or per year. We're great at being able to figure those things out as well. So those are a couple of the foundational pieces from an income planning standpoint, as far as the way that our plan is put together and why that's important. Anything you'd like to add on that, Brian, before we jump to the tax planning section?
No, you hit it.
Okay, awesome. So on the tax planning side, this is where we want to do our due diligence and make sure that you are keeping as much of that hard-earned money as possible. There's going to be a certain tax level for everybody, but nobody wants to spend half or 60% of their paycheck in taxes, right? You want to keep as much as you can. You've worked hard for that money, and we want to make sure that you can do the same thing. And so there's a number of things that can help with this. And most of them fall into the categories of the investment strategy and the investment vehicles. So there's definitely some investment vehicles that are more tax advantageous than others. We talked about a couple of them earlier, where there's vehicles that defer the taxes. There's vehicles that get rid of the taxes altogether. And those can be extremely helpful, especially if you're in a high tax bracket or have additional income sources from your rental income, pension, whatever other things are coming in. And so a few of the basic ones that we talk with most of our clients about, IRA to Roth conversions. That's going to be a major one that most of our clients can take advantage of. And for those that it does make sense for, it's likely to be the largest tax savings available for the remainder of their retirement years. So very important one to hit on. We have a lot of clients that have investments in the real estate world. They've done residential properties, commercial properties, land plots, anything like that. And we want to make sure that you have as much money from those as possible. So whether you want to sell them, whether you want to keep them, there's things that you can do in both circumstances to make sure that you're getting the maximum value out of that. And then we also have a number of tax vehicles that help with different tax types of money. So what I mean by that is there's certain vehicles that lend themselves better to IRA funds, Roth funds, non-qualified or after-tax funds. And so where you put certain tax types of money is also very important to get the maximum benefit out of the hard work or out of the money that you've worked so hard to save up. So there's a lot of different things that we can do depending upon client circumstances. We can get into some pretty nitty-gritty details if you've had owned your own business, been in the real estate world, or staring in the face of a huge capital gain, whether that be through real estate or through just large stock positions. So lots of things we can take a look at depending upon your circumstances.
Okay, I want to drill down on something you said about the Roth conversion being probably the biggest last tax strategy for most people. So I want to give you some numbers, and then I want to have you talk about how we calculate the conversion, where the Roth money should go, because it's in the distribution planning template that allows us to see those numbers. So here's the background. In this example, Arrin, and you probably know these numbers by heart, here's a 60-year-old with $1 million IRA growing at 6% a year. At age 72, he starts paying his required minimum distributions, and we killed him off at age 90. How much tax did he pay? Well, in his lifetime, he paid $676,732 in taxes. But then, according to the Secure Act, the beneficiaries of that IRA had 10 years to pay the rest, which was another $718,496 for a total of $1.395 million, almost $1.4 million. Here is the number that just makes me sick to my stomach. After 30 years of growing an IRA at 6% a year, that $1 million net of tax, what passes to beneficiaries is $1.2,223,385. $1.2 million after 30 years of 6% growth. That should make you sick. The IRS loves the IRA. Congress loves the IRA. The IRA is the most tax inefficient vehicle on the planet, in my opinion. So what we do for our clients is we try to proactively pay taxes now so that the Roth account can do its thing, growing tax-free, distributing income back to you tax-free, passing to beneficiaries tax-free. And it is the superlative intended, the biggest tax saving strategy for most people. So in this case, 60-year-old $1 billion IRA growing at 6% a year, we proactively pay taxes on $50,000 a year, so that at age 72, all of the IRA is converted to Roth. In 12 years, we've converted all of it. Killed him off at age 90. How much tax did he pay? Was it $1.395228? No, it was $319,474. $1.1 million less in taxes. Did we pass a net amount of $1,223,000 to beneficiaries? No, the net of tax transfer was 4 times that, $4,151,000. So talk to radio listeners about how we calculate how much should be converted and where in the portfolio to convert. You would never convert cash or principal guaranteed accounts, right? So tell us how we do the calculation and where those funds go that are converted to Roth.
Mm-hmm. So the goal here is to do it in as tax efficient of a way as possible. For clients that have a really high marginal tax bracket, if you're making $400,000, $500,000, $700,000 a year, might not be the best option for you to do Roth conversions right now. So typically we try to keep people within the 24 and below % marginal brackets. And the way that we approach this is we want to make sure that you are staying within those brackets. So for example, if you are in the 22% tax bracket, we want to make sure that the conversion amount that we do doesn't push you up into the 32% bracket. So right now, where those are very, very close, 22 and 24% federal marginal, we're comfortable with people converting within those brackets, but we don't want to push you up into the 32% bracket. Same thing if you are in the 12% tax bracket. We want to make sure to keep those marginal conversions in that same bracket. And so we wouldn't recommend that you convert $300,000, $400,000, $500,000 in a year, because that pushes you up into a high federal marginal bracket. And so we typically chip away at those IRA 401k balances, those pre-tax balances over the course of a number of years to get that pre-tax money converted over to Roth.
So if you'd like to learn more, talk with Brian, Arrin, and the team at Decker Retirement. It's 833-707-3030. Again, no cost for you, 833-707-3030. Super important to figure out all this stuff before you get into retirement. 833-707-3030. And of course, you could get the 3 Principles Retirement book right on the website, DeckerRetirementPlanning.com, under the heading of Safer Retirement Education. Brian, Arrin, thanks for the time. Enjoy the rest of the weekend. Have a great week. We'll do it again next week.
Thanks, Mark.
Thanks, Mark.
Security and insurance services offered by Decker Retirement Planning, a registered investment advisor with the SEC. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Decker Retirement Planning is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein, provided by third parties, have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Decker Retirement Planning. This radio show is a paid placement.